All right, hey everybody, it's Tim again, and here we are on video number 3. So the first video, we talked about FICO scores, improving your FICO score, so I assume now everybody's got an 800 FICO score. The second video, we talked about ways of saving money. So I assume everybody's got some money for a down payment. Now, this next video I was going to talk about was going to be about the housing market. But guys, I came across this incredible video that was just posted yesterday. And so I'm going to show it to you because it basically sums up everything that I thought. I'll give you a little bit about my input into it. Then we're going to go on to the real exciting part, which is loan strategies and how you can finance this real estate in today's market. Let's just get right into it, folks. All right. So I'm sure anybody, so any of you who know me know that I'm very bullish on the housing market. I've made a lot of money on the housing market. My family has made, my family has been afforded a living, a good lifestyle because of the housing market and because of real estate itself. So I believe in it fully. Now, everybody knows, it's no secret to everybody that after the pandemic, before the pandemic even, there was a run-up in housing, right? The run-up started before the pandemic, but it was like the run-up here, then pandemic, and then, right? It was like off the charts. So now you've got a lot of people out there from different YouTube websites saying that there's going to be a 40 or a 30 or a 50% real estate crash, which, wow, that would excite me so much. So anyway, I was going to talk about that real estate crash because to me, that real estate crash is really an opportunity to buy some more real estate to make some more money in this next round. But actually, not this next round, this round that we're working on right now. All right, so anyway, the video that I was talking about, I want to show it to you real quick because when you look at the thumbnail, initially you're going to think it's like any of those other videos out there that talk about how the real estate's going up 20% per year. It's going to crash down 30% because that's what happened in 2007. So here we go. This is from a kid who probably went through this or at least saw his parents go through this. Let's listen to just a little bit of it. Okay, now that we've talked about in previous videos about keeping your FICO score and getting your FICO score up to the 800 range, and we've talked about saving up money, we're all in a position to buy some real estate. So the next video I was going to do was going to be all about the real estate market because I know what everybody is super concerned about. So right before the pandemic, we started to see real estate really take off, like 2019, 2020, right at the beginning. It was just starting to take off, and then the pandemic hit, and it was like, it dropped off. The certainty was just not there. Everybody wanted to stay home. Nobody knew if they were going to have a job. But soon enough, here comes the Fed to print in some money. Interest rates got down to 0 or negative, whatever you want to call it. We were giving out interest rates in the 2s, okay, as mortgage brokers and mortgage bankers. Mortgages for 30-year fixed interest rates in the 2s. Imagine that when the Fed is shooting for a 2% for inflation per year. So likely to say it was a great year to get mortgage back then. So now that we've talked about getting to the 800 FICO score, saving up the down payment, it's time to figure out which loan option is best for us. Now, there are plenty out there that you're going to hear about from every loan officer, which are going to be your conventional, your FHA, your VA, your USDA. Those are going to be your conventional and your typical loan types. Typically, that's not what we're seeing a lot in the market right now. We're still seeing a lot of real estate investors. And Graham will go over some of the reasons on why we're going to see investors and why the housing market is going to be strong going forward. But what I want to cover is some of the loans that these investors can now take advantage of. So going back to a call that I had just this morning with a client that we've done loans and business since 2009. She knows her real estate inside and out when it comes to single family. Well, me and her started talking. She says, Tim, I got no money. I've got all this money from the real estate planning that we've been doing, from the real estate buying that we've been doing, the renting that we've been doing. We built up our portfolio. We've sold a lot of houses during the boom. Now we've gotten a lot of cash stacked up. We also renovated. We're in the middle of renovating a couple of other flips. We're going to spread some more money out and buy some more housing, but we're having a hard time finding financing. So here, what we wanted to do today in this video is talk about what type of financing are available for folks like this, because these folks are not the only folks out there with this situation. This situation might be for you or someone that you know. All right, let's get into it. And so I was going to do another video about the housing market and why I don't think it's going to crash coming down 30 or 40%, probably anywhere, maybe somewhere, but more than likely I don't see a 30 or 40% crash. So I came across a video on YouTube, a kid named Stephan. At first when I saw the YouTube thumbnail, I thought to myself, great, another person who thinks that we're going to be getting bank-owned properties for 40% off, 30% off. By the way, in 2008, when you looked at the crisis itself, the national average, we lost about 30 to 37% of the values of homes, okay? So keep that in mind, 37%. A lot of people saying 40%, 50%. That's huge, guys. That's bigger than I thought. That's bigger than I can ever imagine it happen. So anyway, I want to take just a minute. I want to show you. I want you to see this video, and I'm going to comment on it. I'm going to show you exactly kind of what Graham's thoughts were in the real estate process. Just a couple of minutes. The video itself is 13. I'll put a link to, in my description below so you can watch the full thing. But I just want you guys to get this information because it's better than I could have. It's better than the way I could have brought it to you myself. Okay, let's watch it. Okay, so now that you've worked on the FICO score, we've got the money saved up for a down payment. We're going to go out and figure out how to finance that house before we go out shopping for the home. All right, so there's going to be different types of financing that your loan officer is going to offer you. Normally, most people that come across our desk have an 800 FICO score and they're putting 50% down, and they can prove their income with a W-2, and it only takes us around 5 or 10 minutes to do the loan entirely. Just kidding about that. That's almost never the situation. I'm actually going to go over a specific loan situation with you, something that I dealt with today, because loans nowadays and real estate nowadays is not in a normal world. So I'm not going to be able to get out to the first-time home buyers or to everybody in the world looking for down payment assistance with this particular video, but I'm hoping to reach somebody that's in a situation like the one that my clients were in that called me today we're going to talk about. All right, so a couple of years ago, as you know, the pandemic started, and prior to that, they had acquired around nine or 10 properties. Needless to say, by 2020, they had tons of equity. And it was time for them to maybe move on from their day job. They had a business that they were running, and they were very successful with their business, by the way. So you know that they had to be even more successful with the real estate. So they did great. Point is, they don't have their company anymore. In 2020, they got rid of it, pandemic, like I said. So they don't have the income. They've got the assets, they've got the credit. That's not the issue. The issue is the income. And what better time now, like Graham said in the video below, to invest in real estate or start looking at investing in real estate than right now. So anyway, they called and said, Tim, look, we've talked to our banker at JP Morgan Chase, and my friend has my son has a friend at Fairway. He told us they don't have any types of loans for people who don't have income. And I'm here to tell you, there are tons of loans for people just like you. All right, we're going to call this particular person Pam, just because I like that name. And so Pam calls and says, Tim, we want to buy this house. The price of the house, sorry, I'm a very visual person. Okay. So the price of the house is $800,000. Okay? We went to the bank to apply for a loan. We need to borrow $500,000. Now, the $300,000, they have it for a down payment, and after the $300,000, they're still going to have $800,000 of liquid in the bank, which they need that for other, expenses, whatever. This is some stuff that they need set aside. So they got the $800,000 plus the $300,000, but they want to take on a loan for $500,000 on a property that is right now selling for $800,000. But that property, once it was fixed up, it's probably worth 1.2. All right. So they said there's no way that they can do this. So they said, look, let's put this together. What we're going to do is we're going to go to a lender. There's tons of lenders out there who are doing these loans. And what are you going to use the property for? I asked them, and she said, Tim, this property here will Airbnb. We found this out from airdna.co. By the way, that's a site that I use. If you're not using it, I recommend it for people who are investing in Airbnb or short-term rental. Basically what it does is it allows you to know what your RevPAR is, allows you to know what your cap rates are, tells you what you can expect for rental income from that particular property. It even shows you all of your competition and all the comps within the area so that you can check on, spy on, maybe even go stay at one of their places. So anyway, we got this $500,000 house. They want it to be worth 1.2, that way they can get this thing on Airbnb. But they got the $300,000 down, and they are looking to put about $150,000 into fixing it up, also for furniture and things of that nature to rent it out for the short-term rental. All right. So what I explained to them is that we're not back in the 2009, 10, 11, 12 era where it was super hard to get a loan because we were literally in a housing crash or a housing meltdown, whatever you want to call it. So a lot of private investors now have conformed to the compliance of the Consumer Protection Finance Bureau, but not conforming to Fannie and Freddie guidelines, still conforming to things like ability to repay and all the other things that goes into the laws and compliance to make sure that we don't have a housing crash like we did back in 2008. So what product we recommended was I said, listen, Pam, here's what we got. You're telling me that the Airbnb on your AirDNA is telling you that this property is going to make you $12,000 per month. Okay, you need a $500,000 loan. That $500,000 loan is going to come with a payment of $2,950. Okay, that $2,950 is before taxes and insurance, because I'm giving her a super high interest rate because she can't apply for a conventional loan through Fannie Mae and Freddie Mac without the income. And we'll talk about how we're going to get her the income so we can prove the ability to repay here in just a moment. So we're going to have to do a different type of a loan. This loan we call a DSCR. What that stands for is debt service coverage ratio. What this means is that if they're getting a property, and let's say that property is going to Airbnb them somewhere in the neighborhood of, $4,000 per month, and their payments $2,950 plus maybe they have $200 for taxes and insurance, or $3,150. Maybe they have an HOA, so $3,200 a month they're paying. But Airbnb is going to give them this $800. They're still going to have all of their money, their investment, their $300,000 tucked away, because as we know, you don't want it in the bank. The inflation will just eat that away at like 9%. 9.1%, as the last reading, it's probably going to be like 10.2 at the next one. So anyway, the DSCR loan, perfect loan for some of the investors that have a lot of money down, good FICO scores, and have found a good deal that makes sense where that debt can be serviced by the loan and by the property itself. All right. Okay, so as you can see, this is just one option the DSCR loan, there's fix and flip loans, there's investor loans, there's pretty much loans on real estate that we have now, we haven't had in a very long time. So when people ask me, or when I see these videos saying 40% real estate crash, 30% real estate crash, it makes me laugh. But it's an opportunity for you. It's an opportunity for me to go ahead and grab some real estate. Well, we can probably find some deals. I'm not saying you're going to get it for 30% off or 20% off or anything like that. Nothing crazy. But what I am saying is it's a good time to find some deals. I'm in the middle of a deal right now, and I'll post about it once we finalize the deal. But I'll tell you how it's going. We're buying a house right now. It's going to be a rental property, and we're doing this completely legit. But we're buying in a rental property, and our interest rate on that rental property is going to be at 2.9%. We're coming up with not 20% down. You ready for this? 17% down. We're not paying mortgage insurance. And yes, we're getting interest rate way below the threes. I'm sorry, way below the fours. We're below 5, 6, and 7s, but we're below anything anyone else is getting. So anyway, once that deal wraps up, then I can at least share with you the details of it and show you the other types of financing, the creative ways that you can get into real estate right now, because now is a good time. I don't care what anyone says about this 40% real estate crash. I don't see it coming, and I'm putting my money where my mouth is. Okay, now, there's a second way I want to show you that we could have taken advantage of some different type of financing, or what I call strategic financing. The same borrowers that we just talked about, that were talked about with the DSCR loan. All right, let's get into, like I said, I'm a visual person, so let's get back to my whiteboard. Okay, so like I said, we had $800,000 of cash. They want to put down $300,000, leaving them wanting to finance $500,000. Like I said, the mortgage payment all in with taxes, insurance, principal and interest, HOA, everything all combined was $3,200 per month. Now, there's a clause in Fannie Mae and Freddie Mac, FHA's book, that talks about income and when it can be awarded and when it cannot be awarded. And one of the types of income in there was called trust income. And so I found this income a few years ago, and I had almost this exact same scenario. So what we were able to do is basically looking at Fannie Mae's guideline. What we were able to do is see that what Fannie Mae and Freddie Mac want is, first of all, they want a history. So we want 3-month history of somebody receiving this trust income. And they also want to make sure that after the loan closes, there will be at least 36 months worth of payments coming to them. Okay, so let's look at the financing on this real quick. For a Fannie Mae and a Freddie Mac type of a loan, which is where you're talking about getting those lower interest rates than what you're going to get in the private market, okay? So we have trust income, 3 months plus we need 36 months. We need $3,200 per month for the loan, but this person, let's say, needs $5,000 a month here to qualify. What happens? Well, we take $5,000 times 40, just for round numbers, and we put $200,000. That's right, you guessed it. You put it into a trust. Now, in that trust, you're going to have it irrevocable, and that trust is going to pay the trustee $5,000 per month for 40 months. 3 months goes by, now you've got a history of receiving the trust income, proof that you have 36 months payments after you close, and now you've got a Fannie Mae, Freddie Mac type of a loan. By the way, this could be done on an owner-occupant this is not something that we can get tricky with and do with a second home or a vacation property. Actually, second home maybe, but either way, vacation property or investment properties are a little bit different. It's a little easier with a primary residence to get this type of financing. So anyway, strategic financing is still available. It's going to be coming up. It's going to be very important coming up in the very near future. Okay, so now we've talked about a little bit about the real estate market. We've talked a little bit about strategic financing for some of us out there who want to take advantage of strategic financing and get into some of these homes right now. Let's talk about the next step. Is once you're ready to do all this, where do you go and where do you start? And I'll tell you right now, folks, start with a mortgage broker. Not a loan officer at a bank, because they are tied down to the products that their bank offers. Not that they're bad. I love working with banks. We work with tons of banks. But as a broker, we have the ability to choose which bank we're sending that client to. So if one of our underwriters doesn't, my underwriter doesn't like this scenario, and they're like, Tim, you just tricked me. I'm not going to approve this loan. I think you're too tricky. And that loan officer is at, let's say, Caliber. Well, then maybe I'll take this loan over to UWM because maybe their underwriter likes the way that I put together the file a little bit better than Caliber. I'm okay with that. We're just here as a broker to make sure that you're going to get the most strategic financing for your specific scenario. We're not locked down by products that banks are locked down by, because our relationships are with any banks that will take the brokered loans. Okay, so if you're looking for any type of a loan, whether it be conventional, FHA, or DSCR, fix and flips loans, find a mortgage broker in your area. I'm licensed in Arizona and Colorado, not licensed anywhere else, but I have a huge network. If you're interested in talking to one of us, I'm going to have a link below. If you're interested in us connecting you with one of our realtor partners or lending partners in another state, go ahead and contact us with the Contact Us button below, and we'll get you with one of those partners so that you can get some strategic financing as well. All right, guys, thanks a lot for taking a little time with me. Hope you got a little information out of it. If you don't mind, hit that like, subscribe button, notification bell, and we'll see you in the next one.
Basically the three things, or two of the things that make up a crash. Number one, you have supply. Number two, you have demand. I know it sounds crazy, but that's really the simplest of it. So let's cover some data. We're going to look at some supply. We're going to look at some demand. On top of that, we're going to go into all the data, and at the end of it, what I want to do is just bring this all together and let you guys know what I think might be happening.